Right then, we'll be getting to the business of food a little later in the program. Let's start with monetary policy, specifically the decision by South Africa's Reserve Bank to leave its main interest rate unchanged, despite increasing inflationary pressure and a far weaker rand. As was widely expected by economists, the SARB's MPC met and chose not to tinker with the benchmark repo rate from its previous level of 6%, last set around July. Governor Lesicha Kanya, says the combination of sharply slowing growth and rising inflation compounds the dilemma facing monetary policy in South Africa. Now, this decision comes in the wake of a 25 basis point hike in July, which some economists vocally disagreed with. The rand declined by almost 20% against the dollar so far this year. On Tuesday, the central banks of Kenya and Nigeria also decided to keep their powder dry. Like other emerging markets, South Africa is trying to balance between the inflationary effect of a weaker currency alongside a contracting economy as a result of falling commodity prices.
The global economic outlook has become more uncertain since the previous meeting of the MPC, driven in part by the strong financial market reactions to the deteriorating outlook for the Chinese economy. Although the growth prospects in the US remain positive, they have been clouded by growing concerns about possible spillbacks from a slowdown in emerging markets, particularly in China, as well as from the impact of the strong dollar. Euro area growth moderated in the second quarter and remains relatively subdued, whilst real output in Japan has declined.
Let's get more details on what exactly went on in that MPC press conference. Mission Niger is live in Johannesburg right now. With inflation back under 5%, do economists expect it to remain there for the rest of the year, or are there factors that could push it past 6% by December?
Well, Rama, the Reserve Bank expects inflation to average 4.7% this year and possibly breach the upper end of the 3 to 6% target band early next year. The bank is very concerned about inflation, and as the governor said earlier, more especially because food prices are starting to tick up and starting to feed into that inflation. We are also suffering drought conditions. Food makes up a big chunk of the CPI basket, but the rand remains the single biggest threat to inflation. So today we were surprised to see inflation easing back in the month of August. That was largely as a result of the low oil price, but with the rand set to weaken further on the back of a stronger dollar, and more so after the US Fed decides to hike rates, there's widespread expectations that inflation will breach the 6% mark.
Indeed, there's speaking of those inflation numbers, there's quite a bit of cost pressure as well coming through in the housing and utilities index. Is most of that attributable to the rising cost of electricity, or are there other factors at play as well?
Oh yes, electricity remains the major contributor in this regard. Prices have been going up steadily in recent years. Eskom even applied for 2 price hikes this year. Now, while the power cuts seem to be under control for now, new power supply is running behind schedule, and with warnings of limited supply for the next 2 to 3 years, residents and businesses are increasingly spending on alternative and renewable energy sources. There's been no guarantees on power supply. Last year, the power supply crisis shaved off 1% of growth. The governor today again commented on the impact the electricity shortage has been having on key sectors like mining and manufacturing, so still a real concern.
Indeed. One last question for you, Sumitra. Allow me to move into the heretical sphere, if you will. Given a possible rate hike from the Fed sometime in either December or January, persistently low growth, rising inflation, doesn't the MPC at some point need to just bite the bullet and cut rates in order to bootstrap growth?
That's a tough one. And, you know, the Reserve Bank is in a really tough position. And the governor alluded to that today when he said the MPC had to achieve a fine balance between realizing its core mandate to keep inflation under control and not undermining short-term growth unduly. So while the bank is very concerned about inflation, it's more concerned about economic growth. If you look back, the Reserve Bank used a monetary policy for about 2 years to help stimulate growth in the South African economy. Inflation had breached the target band then, and growth remained subdued. And eventually, the bank said it could no longer hold off on rate hikes. In terms of a cut, economists believe it's just too dangerous at this stage, as we could head into stagflation. We already have low growth and high unemployment, and with the rand likely to remain weak or even slip to even weaker levels, inflation could push up significantly. So I don't think that a rate cut at this point was even a discussion for the Reserve Bank.